For more on this story, we're joined by the Group CEO at Tiger Brands, Noel Doyle, and he joins us to give us some insights into what he thinks. Noel, thank you very much for your time this afternoon. You've heard the market, well, at least one analyst saying these are disappointing numbers from Tiger Brands in the half-year results. How do you characterize your performance in the past 6 months?
Yeah, look, I think the analyst's comment is fair comment. And I think particularly in the light of the guidance that we had given the market in February and the subsequent significant challenges that we had in terms of consumer demand, it's not an unfair comment. I think we have been in an environment where consumer spending's come under a huge amount of pressure. We're in the second year of double-digit, mid-teens food price inflation, together with the interest rate pushes, and we've certainly felt the brunt of that in terms of the sort of contraction in the consumer's wallet. Many of the categories in which we participate, the total market volume-wise is in decline, and where we grow, unfortunately, we grew at lower margins in our milling and our rice business. So from our perspective, a disappointing set of results, and we have to kind of rebase and set ourselves for an environment that we think is going to get worse before it gets better. And we've got to keep doing the good things that we have done, but quite clearly in this environment, we'll have to go after costs.
Noel, something that many companies can't run away from, and we've spoken to a lot of CEOs talking about load shedding, our power crisis adding to the woes for many companies in South Africa. You have, as Tiger Brands, you're spending on load shedding to mitigate against load shedding. It was 12 million in the same period, previous period. Now it's risen by 48 million rands. This is a huge risk, and operationally it adds to the challenges that you have.
Yeah, I think that's fair comment. Look, I think the whole of South Africa faces that challenge, but I wouldn't like in our results to hide behind the impact of load shedding. It was a significant contributor, and apart from the pure cost of generating electricity, there's also the impact of inbound supply conditions. I think, we're in the fortunate position, and many aren't, where we are actually, all other things being equal, we're able to continue to operate, and we've contingency planned all the way up to stage 10 in terms on the basis that we get the raw materials that we need. We should be able to continue to supply the market. So it's a factor, and it's a complication that it introduces complexity in terms of our planning. But to be quite honest, the bigger challenge for us is getting the right price points for our brands in a really tough consumer environment. So we're not going to hide behind load shedding. It's a factor, but it's not the big issue for us.
Noel, let's talk about food prices. There's a high cost of living. We've been talking about it for months, egged on by a rising inflation. How are you trying, or your initiatives to save costs and actually make sure that the financially hard-pressed consumer can still afford food, at least from Tiger Brands, such a massive food producer on the African continent?
Yeah, so look, we obviously have to look incredibly carefully at our procurement. We have to look at our packaging, sourcing alternative, cheaper options. One of the highlights, unfortunately, you don't really feel it in the numbers, is the productivity in our factories has been on the increase. Our sort of wastage factors have been declining. So in that respect, we've worked quite hard, and we set a target of over 500 million in cost reductions for this year. We intend to be ahead of that. In fact, we're tracking ahead of that, and I suppose it's quite clear that isn't enough in this environment, and that's why I say we're going to have to go deeper and broader in terms of our costs. But unfortunately, despite some of our commodities coming down in terms of international prices, the impact of the rand discussed earlier by your previous guest is really a factor that's kind of washing out any of the gains of declining international commodity prices. So we still think that if we look at our second half, there will be some relief in our basket, but we will probably still be close to, if not into double-digit food price inflation, but probably significantly lower than the 17% that we've reported for this 6-month period.
Let's talk about the outlook for the company for the next half of the year. What is keeping you awake at night in terms of how the South African economy in general is actually doing and the challenges that await you in the next half?
Look, really it's the sort of the cumulative impact of the blows that the consumer has faced in terms of a massive increase year on year. I think we underestimate the impact of the interest rate hikes from where we were a year ago. The fact that we're into the second year of very high levels of food price inflation, increasing employment levels. It means that disposable income, we're all going to be fighting for a pie that is shrinking in real terms, and we're really going to have to be super sharp in terms of our promotional and pricing, getting our price relativities right. And again, we're going to have to go deep on the cost. So I do think that the outlook, the macro outlook, is that it's going to get worse before it gets better. And we are in many ways the barometer of families, average South African families' financial position in terms of their ability to reach to the premium price points that many of our products command. So really quite a challenging outlook, and that's why we're guiding to say, it will be a really difficult job for us to repeat what was a very good second half last year. So, we have muted expectations, but obviously we're going to work hard to try and beat those this time.
Noel, thank you very much for your time this afternoon. Noel Doyle, the Group CEO at Tiger Brands, one of Africa's biggest food producers, talking to us there about the impact of the rand slump, inflation, load shedding in the past 6 months for the company, and telling shareholders that the next 6 months are going to be somewhat of a difficult period for the company, as we've seen some of the economic hardships South Africa is in at the moment.